This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Our guest is Brian Hamrick. Thanks for being on the show, Brian.
Hey, Whitney, it's great to be here. Thank you.
Yeah, honored to have you on the show. Brian controls over $32 million in apartment, self-storage, and office commercial real estate, as well as performing and non-performing notes. He's raised over $9 million from investors through syndications and funds, and he also hosts the Rental Property Owner and Real Estate Investor podcast. Brian, welcome to the show. Give us a little more about your focus in real estate, and let's jump into your superpower and the thing we're going to just dive into today to help the listener.
Yeah, absolutely. So, Whitney, thanks for having me on your show. I'm an opportunistic investor. I invest in apartments. I invest in office, a little bit of retail. Self-storage is one of my favorites, and performing and non-performing notes. And I've also dabbled in some ground-up apartment development too. So I've done a lot, worked with a lot of great partners, and I always like to come prepared to shows like yours, bring my A game. So I actually thought, I've had a lot of conversations in the past couple months about fund structure, because I've started a fund. I spent about a year trying to figure out how to do a fund. And if it's okay with you, I'd love to talk about fund structure today. It's not necessarily my superpower. I'm not an attorney, but I've certainly gone down that road and would love to talk about it.
No doubt about it. I would love to talk about that. And I appreciate you just bringing it up and that spending a year of research, learning this, you're going to be, so much more knowledgeable about this than I am for sure. But it's just that you've done it too. But I want us to get into what you're talking about versus say the normal syndication or deal by deal syndication that some people have heard called different things. And you just elaborate on the pros, cons, and we'll get into some of that. So thank you for that. Thank you for being on the show. But let's jump in. Tell us a little about I guess I want to back up. I was going to say the fun that you did, but back up a little bit to even your research for a year. Where did you go to find research? What were the main things that, helped you, Brian, to learn even, most of the things you're going to share with us today?
Well, I looked for books on the topic, could not really find many books. I went to networking events, national networking events. And probably that's the best source to find people who have actually put their own funds together and talk to them and say, why did you structure it this way? How did you structure it? What were some of the considerations? And really, when you talk to 10 different people who have started 10 different funds, you get 10 entirely different answers as to how they went about it and what kind of structure they have. So it can be confusing and daunting. But before I get into that, let's make sure people understand what a fund is and how it's different from a syndication. I've certainly syndicated apartment buildings, self-storage. These are single asset syndications where you identify the property, you identify the closing date, you go out, you raise your money, and once you close, you've got your investors, they're locked in, and maybe you hold it 5 years, 10 years, whatever, but that's a single asset syndication. And I know you've done 100 million in syndication, so you're very familiar with that process. Now, but let's say you want to go out and you're not sure what you're going to buy, but okay, there's a lot of retail right now because of the coronavirus pandemic. There's a lot of distress right now in the retail area. That's what I mean to say. And let's say you want to go out and just pick up distressed retail centers, shopping malls, strip centers, things like that. But you're not sure exactly what the asset is going to be. So you might start a fund that is meant to raise the money before you identify the asset. And it could be multiple assets that you would pick up in this fund. And that's why you would do a fund structure as opposed to just a single asset syndication.
Okay, so there's a lot to think through there, right? Why we would do this and when and who should do this. So maybe even some of the timeline, people are thinking, okay, well, when am I going to be raising the money, or when's it going to be deployed, and some of those things working or to think through. But maybe we can start with even the types of properties we should be thinking about acquiring, or do they have to be the same, or can we purchase different types in that fund? Just elaborate on that.
Yeah, so I'm not going to talk about any fund that I may or may not have done because it's a 506B, but I'll just kind of take you through it in general, kind of from a general perspective, because I'm not an attorney or a CPA. So you should always, of course, talk to your experts on your team about these things. But as far as identifying the asset, if you're an apartment investor, You might say the assets that we're going to go after are distressed assets that are in the 20 to 40 unit range. And we're going to pick these up for $1 million to $1.5 million each. We don't know what they are yet, but we're going to raise enough money so that whenever we see those opportunities, we can close quickly because we've already had commitments for the funds to close. And we may not even need lender financing because we'll be raising that money from our investors. So that's from the asset side, you want to identify what the asset is going to be. Is it going to be apartments? Is it going to be retail centers? Is it going to be cryptocurrency? Whatever it might be, identify that, but then also think, well, what if we're investing, what if we're only going after retail, but we come across an office building that's distressed that we can pick up and it makes sense? Do you want to widen the parameters of your fund and make sure that, it's transparent to your investors in such a way that you as the operator have the leeway to include office in your retail? So you have to take these things into consideration when you're putting together your fund.
Any kind of time frame restrictions or the duration of the fund, things like that we should be thinking about?
Well, yeah, that's always important because let's say you're buying apartment buildings. Well, what is your window of time that you need to be able to acquire these? Is your fund only going to be open for a year? You're going to acquire these assets, achieve the upside value, and dispose of them within 3 years, 5 years, 10 years. You need to figure that out. And because you're on kind of a staggered schedule, you don't know when you're going to find the asset. You don't know when you're going to close on it. You don't know how many assets you're going to find and over what period of time. You need to build that flexibility into your fund to say, you know what, this may not be your traditional 3 to 5 year fund. This may be a 7-year fund or a 10-year fund. And you have to really think about it in that way as to, well, how are you going to get your investors in? And how long do you need to let them know that they're going to be in that fund?
They definitely are going to want to know, right? They're going to want to know when all these things are going to happen. And so you better have an idea about this time period that you're projecting. But, thinking about those people that you're talking about, those investors, you have to project some kind of return, right? And how do you do that or the returns you'll be offering to investors?
I always say that's a marketing question. You have to know your investors. What are their timeframes? I mean, I have investors who are in their 70s and they've told me, I don't want to invest in something for 10 years because I may not be around for 10 years. So, does that mean I need to make it a 5-year fund? And would that even work with the type of asset that I'm buying under the parameters under which I'm buying them? The returns are always different. And like I said, you talk to 10 different fund operators, you're going to get 10 different answers. So I've talked to operators in the note world who basically their fund is, you invest with me and you're going to get a straight up 8% return. If you invest over 150,000, I'll make it 9%. And that's it. It's just a flat. There's no equity upside to that. And then you have other people who structure their fund much like we might structure our syndications, where you have a cash on cash preferred return each year, and then an IRR, an internal rate of return or annualized return that's 18, 20% once you liquidate. The problem is, because it's kind of a blind pool, you don't know exactly what asset you're buying. So you're not able to run the numbers really completely before you raise that money. You don't know exactly what the returns are going to be. So you have to make sure you build in all kinds of cushion and take into account all kinds of variables to be able to get to a return that your investors will get excited about. Because again, it's always a marketing issue. You don't want to come out with 4% preferred return and 5% annualized return because investors will just say, well, I can go to Whitney and do much better. And so you want to make sure it's sexy enough for your investors, but not overly sexy in which you can't deliver.
Are there any other things about just specific ways to provide those returns or, that you're providing them to investors?
Well, there's the easiest way is just a straight up preferred return, 8 to 12%. That's what you're going to get. And, it's a 5-year fund and we'll get you your money back at the end of 5 years. That's the easiest way because it requires very little bookkeeping. As you get into more detailed returns with preferred return, cash on cash, annualized return once you dispose of the assets, then there's a lot more bookkeeping. And, it's very easy with the cash on cash return to say, all right, when this investor invested from this date, their cash on cash return starts there. They get a certain percentage prorated for the amount of time they've been in. But when you get to the annualized return, which is once we've disposed of all the assets in this fund, we've paid back our investors, and now we're going to pay out the profit, you need to be able to make sure that the people who got in early and the people who got in later are being compensated equally, or their compensation is balanced, because you don't want to have a lopsided fund where the later you get in, the more profit participation you're going to get in the back end. So that was something that I really had to struggle with to figure out mathematically, well, how do we make sure that someone who gets in early is going to have the same annualized return or internal rate of return as someone who gets in late? And that was probably the biggest challenge. And I do you want to hear the answer?
Yeah, well, of course.
Okay. So what you have to do is you have to take a weighted ownership ratio for each investor. And that you're basically weighting the number of days. When I say weight, it's WEIGHTING, weighting the number of days that they're in the investment with the number of units or shares that they've purchased. And then that gives them a percentage of ownership that is then applied toward that annualized return when it comes time to pay that out.
Our guest is Michael Episcope. Thanks for being on the show, Michael.
Thank you for having me, Whitney.
Michael has lots of skill sets in this business. They've grown an amazing brand and business in the syndication space, and has many things we're going to discuss today, but specifically about funds and how they have structured funds, how they operate funds, and just giving us some advice there from his expertise. But a little about him in case you missed the last show. He's a principal of Origin Investments, co-chairs the investment committee, and oversees investor relations, marketing, and company operations. He brings 25 years of investment and risk management experience to the company, and believes that calculated risk taking in inefficient markets is the key to building wealth. But why don't you just at a high level talk about funds a little bit, how you all, what you are using funds for now, and let's dive into some of the details of how you all pick maybe certain types of funds or structured them.
Sure, absolutely. Yeah, I want to comment too, because it's funny hearing you read my bio there and calculated risk taking. What that really comes down to is the rule number one: don't lose money in investing, and that's what it's about. We've been investing since 2007. That's when my partner and I started the firm, and it was very quickly that we decided to structure things as a fund, and a little bit different than a lot of syndicators out there and things. And the reason why we did that was we just believe it's a better way to invest. It's better for us as managers, and I'll get into that, but it's also a better way for investors to invest as well, because it provides diversification. Fund is really like a company as well. And you think about the managers promote, and when you do individual deals, the managers promote is not cross collateralized, meaning if you do great on one deal, the manager is going to get paid. If you don't do well on another deal, the manager won't get paid, but net, they do get paid on those deals. So in a fund, all of those promotes are performance fees are cross collateralized into one. So when we're really thinking about adding deals to the fund, there's a lot of time and effort and discipline that goes into that. And our whole team is compensated through the fund structure as well. So we have a credit committee that goes well beyond my partner and I. It's also all the team members who have a vested interest in the fund. And when people bring deals to committee, when our acquisition officers do, those are scrutinized, and they're heavily scrutinized, because the wrong deal can taint the entire fund. So from a discipline standpoint, there's a much higher bar for what gets into the fund, because when you have $200 or $300 million in a single fund, and one deal has the potential to kind of bring the whole thing down and bring you below that preferred return, it's a different threshold. And then when I say it's better for us as managers, what I mean by that, I'm sure most people's minds are going to the fees. The fees are actually not any different. So we charge an asset management fee. In most cases, you're going to get that on a syndication. We'll either charge a committed fee on that capital or an acquisition fee, and you're going to get those same things on syndications as well. But for us, when we're going out to the market and we're competing for deals, the biggest thing is proving that you have capital. And when you come to the table and you are one of 3, one of 5, one of 10 investors who are looking at a deal, and the seller is trying to qualify you, and somebody's coming, well, we don't actually have the capital, but we can close, trust us. That's not as good of a story as saying, look, we've got a $200 million fund and we can close in 30 days. And in today's market, that's incredibly important to have that advantage, to be able to close quickly, use the fund capital, knowing that you have investors there who are ready to write a check for a deal that's approved within a box itself. So there are a multitude of advantages to a fund. I know some people don't like to give up that control. They like to actually pick and choose their deals. But I think understanding, the benefits, the pros and cons of both is really, really important. And the last thing I would add is sometimes it's not an or, it's an and. So we actually, in our funds, tend to use sidecar vehicles. So for deals that maybe are too big for the fund, if we're only going to put $15 million of equity into the fund, but the deal requires $25 million, that $10 million then goes to investors in a sidecar vehicle to fund investors, generally at more favorable fees, so they can invest in that deal. And they can know, investing in that deal, that this has already been vetted by us, by the fund managers. This is something that we're putting into the fund. So it really shortcuts that, because you've already made the decision to invest with us, with Origin, in this fund. It most likely fits your risk profile. So those are actually advantages as well when it comes to even, when we're syndicating side deals and participating in individual deals.
So incredible there. I mean, you answered so many of my questions before I even asked them, which is great. But while you're talking about sidecars, it's something I've heard a lot more about recently. And I think as more people are looking into fund structures and how to do this, it's something that's coming up. Can you speak, though, to which investor is going to invest in the fund versus the sidecar, and why?
Well, believe it or not, a lot of fund investors, I would say 80% of them are interested in sidecars, sidecar vehicles, because for the reasons I just mentioned, they know that they've already been vetted. These are deals that we like. These are deals that we have high conviction in. And oftentimes, if somebody's putting $500,000 into a fund, they have more money that they're willing to invest. So they're very likely to come in to a sidecar vehicle like this. So it's a large portion. And what we found more than anything is that this is going to be a bigger part of our business going forward. And it's something that's in high demand. And for the few deals that we have syndicated, the demand has been so overwhelming that it's difficult to give a piece to everybody, because in our funds, we might have 300 or 400 people. And when you have a $7, $10, even $15 million deal, those end up being fully subscribed within a day or two. And so there are a lot of investors who end up not participating because we generally do this on a pro rata basis. So we're going to go out to our largest investors first and give them a piece, and then kind of work our way down the reins. But what we found is that everybody really wants to participate, or that 80%. So going forward, even as we're concepting a new fund that's going to be out, we'll be marketing in the third quarter, and then we'll be coming out with it in the fourth quarter. But almost every single deal will have a syndication component to it, so that investors can get a piece of those individual deals as well.
Okay, so just to bring some clarity there for the listener, so you're going to have this big fund that will be purchasing numerous projects, right? And then investors may invest in the fund, and they don't know the exact deals at that time yet, right? They're trusting you all, they're trusting your group, they understand the risk level, those things, the type of fund that you're doing. But then the sidecar is going to be deal specific, right? And so you have this deal you're moving forward with, and then you have a sidecar that's attached to a specific project. Is that correct?
That's 100% correct. And if, I'll give some tangible examples. So if we come out with this fund in the fourth quarter, right now we're targeting $150 million in fund size. And so when we're looking at, from a risk management perspective, about how to allocate and diversify across this fund, this will be all ground up development. We'll have about 8 to 10 deals in there. And there's also what we call a GP sleeve, a general partner sleeve. So those are high margin deals where we are participating in the general partnership. But the other, 8 or 9 deals that will be in this fund, we don't want any more than 10% of a deal in the fund. So if your typical ground up multifamily development deal is $25 million and we're putting $15 million in the fund, that requires $10 million of additional equity as that sidecar vehicle, and investors are participating right alongside the fund in those. But when you add that up, that's almost $100 million in syndication. So the net of it is the fund will have about $150 million in committed equity. Those fund investors will get the first look at those sidecar opportunities, which will be about $100 million. So in all, that's about $250 million in deals that we'll do in that particular fund itself.
Will your fund be 506B, 506C?
506C.
And then something I've learned recently, though, what about your sidecars? Because they could be a 506B then. Is that correct? Or do you all do that?
Yeah, we operate under the 506C rules, even in sidecars. So, with those, again, that's more, we don't market those per se on a broad marketing, because generally all of those sidecar interest, they get gobbled up by fund investors. So there's no reason for us to broadly market those. And it's usually an outreach by our investor relations department going out to individuals in batches and letting them know about the opportunity. But nonetheless, there's no reason for us to use 506B when we can use 506C. It gives us a little bit more room to maneuver.
Sure. What about just the structure of the fund? And so just so the listener can understand, you can structure them almost any way you can think of, right? But some common ways, I know recently I've heard people talking about just like 70-30 split, or some people call it like a 80-22, like a 80-20 split, then like a 2% acquisition fee or something like that. But how do you all structure that? How do you think through how to do that?
Yeah, so you're talking about fees, and I think there's a couple of things. So in our funds, I'll start with sort of the legal structure, if you will. So we have two funds that are operating today, and then one that is on the horizon. And with our funds today, we have an income plus fund, and that's more for the income-oriented investor. That has about a 6.2% annualized yield. And then there's another, call it 3 to 4% of appreciation that we're targeting in that fund for a total return of about 10%. And that fund actually has a REIT blocker in it for tax advantages. But you're investing through an LLC. So that, for people who are investing in non-taxable accounts, the REIT blocker helps with blocking UBTI, and it has other tax advantages, the 20% deduction as well. In our QOZ fund, we do not have a REIT blocker. That is purely an LLC that you're investing in, and that has some great tax advantages. And then in the next fund that we're going to be coming out with, that will also be an LLC, a limited liability corporation, to which investors will get a K1. And I'm not sure if we're going to do a REIT blocker or not in that fund. But you're talking about specifically fees, Whitney, I'll get to that. In our Income Plus fund, what we charge is a 1.25% annual asset management fee on that fund, and then a 10% performance fee. Now, the advantage to that fund is it's open-ended. And so when investors are coming in to that fund, they're investing all of their capital at once, and they're diversified across the existing deals in that fund. So it's a little bit different than a closed-end fund where you commit your capital and then it's called over a period of time. And there's a big advantage to having all of your capital working at once. And that fund is then marked to market on a monthly basis, and dividends are provided on a monthly basis as well. If you don't want the dividend, you can enroll in the DRIP and you can just reinvest those along the way. And then in our QOZ fund, that is purely ground up development. That is also a 1.2, I actually forget. I think it's 1.5 or 1.25. I'll go with the higher number so people don't call me out. It's still a good number. 1.5%, and then a 15% performance fee. And in all our performance fees, and this is there's the thing about this market is it's kind of all over the place where people charge fees. And I understand this. What you have to look at from an investor is really compare the gross to net. So you look at what it is at the end of the day. If two investment managers are saying, look, at the end of 5 years, you're going to double your money, right? That's the pro forma, right? Let's throw that out, how accurate those are for a second. But what matters is the gross to net, right? There's always going to be fees in these funds. We have a team of 30 who are working on behalf of almost 1,600 investors. So our fees are the annual asset management fee. In some cases, we do get an acquisition fee. In some cases, if we're structuring a fund, we might do a committed fee. But in fact, this fund that we're coming out in the fourth quarter, we've actually decided to go away from the committed fee after talking to our investors, because they would much rather have the variable cost of an acquisition fee than the committed fee. And what a committed fee means is that if you have a closed-end fund and you commit $1 million to the fund, you are paying whatever that annual committed fee is from the day that you make that commitment. So if it's 1.5%, you will be paying that manager $15,000 a year starting on day one. If you look at it from an acquisition fee standpoint, then you're only paying once the manager finds a deal, right? The fees generally come out to the same as long as there's a velocity of capital and the manager is doing their job. If we're doing our job and putting out capital in, call it 2.5 years. But if we're not, then the risk falls on us and not the investor. So that's always a risk of investing in a fund. You commit to $1 million and the manager can only put out, $600,000 or $700,000 and you've paid fees on the whole thing. But the way that we're operating, going forward is we're just trying to create better structures, more friendly to investors and meeting the market demand and continuing on our structures going forward.
Thank you for being with us again today. I hope you have liked and subscribed to the show. Please tell your friends about the Real Estate Syndication Show. And I hope that you are learning and growing. Don't forget to go to lifebridgecapital.com where you can start investing today.